Hello, everyone, and thank you for joining today's event titled Predictive Analytics and joint ACCA and IMA Switzerland Chapter event with Horváth Partners. My name is Levki Bandeli. I am a Member Engagement Manager here at ACCA, and today I have the pleasure to be co-hosting this event with ACCA's Ambassador in Switzerland, Jérôme Vial, and Marco Otti, Director of the Europe Board of IMA. Jérôme and Marco have done an excellent job putting this event together with a stellar panel of speakers. So before we begin and I give Jérôme the floor, I just wanted to cover a few housekeeping items. At the bottom of your screen, there are a number of buttons you can use. We do recommend viewing this webinar in Google Chrome for the best experience. If you have any technical issues, please try logging out and back in or refreshing your browser. During the event, if you have any questions, please use the Q&A button to submit your questions. This webinar does provide 2 CPD units, and the certificate of attendance will become available at the end of this session. To download the certificate, please click on the certificate icon. Jérôme, the floor is yours.
Thank you, Levki. Welcome, everyone, to our event here about predictive analytics. My name is Jérôme Vial. As Levki said, I am the ambassador for ACCA for the last 10 years here in Switzerland, and next to my role as a country manager for Tagetik Switzerland. I'm organizing this event together with my friend Marco Otti from IMA. Marco, I'll let you say a few words about yourself. Marco?
Yes. Thank you, Jérôme. Yes. So, hello and welcome. Hello and welcome on behalf of the IMA Switzerland Chapter to this joint event on predictive analytics. I'm a board member of the IMA Switzerland Chapter and also a group controller for Autoneum, a global automotive supplier. Along with all of you, I'm looking forward to learn more about how to use algorithms to predict the future. So we are excited that today's event has attracted a lot of participants, right, Jérôme?
Correct, Marco. Yeah, we are very pleased that more than 1,000 participants from ACCA and IMA registered for this event. So very happy about all of you coming for this event. So as we said, it's clearly a hot topic there, which has become very popular because of the increase of the amount of data available in company. It has become also easier due to the amount and increase of computer power, which allow there to be much better in this area. So IT has a very big role to play in this trend, okay? And what is predictive analytics? It is to answer the question, what is the most likely to happen based on my current data, and what can I do as a company to change that outcome? And for that, it uses historical data, machine learning, artificial intelligence to predict what will happen for your business in your companies. By using predictive analytics methods, company can empower their end users to make better decisions and to take corrective action. One of the key challenges for this project is clearly to adjust and adapt that smoothly in the current business of the company and the ongoing processes, okay? So for this event, we are very pleased to have with us top experts in this field. We have 3 speakers for this event. First one is, as you can see there on the slide, Dr. Mario Staffan, who is the head CFO strategy and finance at Horváth Partners, based in Zurich. We have then Kleber Sasaki, who is a controller manager at Clariant North America. And finally, we have Ralph Landolt, who is the co-leader at AI and automation practice at Boydak. Okay, and very important, we will have at the end of the 3 speeches a Q&A that Marco will moderate with all of your questions. Okay, so let's now jump into the topic. I would like to introduce Mario from Horváth Partners. Mario studied business economics in Germany, in the Netherlands, in Switzerland, and in the US. He holds an executive MBA from New York University, and he finished his doctorate on system theory and cybernetics in Hamburg. After more than 20 years in consulting with CSC, KPMG, and PwC, today at Horváth, he has a very broad experience in this field. Mario, the floor is yours.
Thank you very much, Cheryl. Yes, so welcome all. I will share a little bit what we are working on currently, mostly in the field. And the one term that you should learn from this presentation is what an algorithmic target operating model is, or better, what the philosophy behind this. This is my data. You will get the slides afterwards. And I also will not spend too much time on our company, just for those who haven't heard. Horváth Partners, we are about 1,000 management consultings. We are a global network with our partner firms. We are very heavily engaged into everything that deals around steering and performance optimization. And the one thing that is very relevant for today is we have our own steering lab, so in-house data science lab with enormous machine and learning and calculation power. And to just give you one idea, when in the UK they were optimizing the traffic net, the whole optimization and scenario calculation were done on our machine. So we have a lot of calculation power. This is the steering lab with our partners from Boyduck and SAP. We are heavily involved in all the other major topics. And I think we are doing a good job. But as I say, this is, you get the slides, you can investigate further. For today, on the target algorithm model, let me start with one important thing to understand, and that is that the Corona crisis already showed that those who were engaging into linking process automation with data science and everything, they were the ones who came way better through the crisis. And that was the conclusion. This was from an event couple of weeks back when we had to conclude what we see in the market. And the number 6, the algorithmic target operating model, that is the one thing that drives ROI. What we can also see is, if we look at this little picture here should indicate it's pretty much true for all major developed countries, and that is most organizations have already first experience with the topic. They have proof of concept, they have some pilots, they did some assessment, but they all struggle with really scaling up the whole topic of digital, of advanced analytics, of predictive. And there is a reason for that. And there is a common reason for that. And the one common reason is that in today's world, where we all shift from a pure functional focus more to an end-to-end point of view, record to report, idea to market. And all this end-to-end process, what we see is all the data is not within one end-to-end process. So from function to end-to-end is already a big step. But in machine learning, in predictive analytics, in advanced analytics in general, typically you use all kinds of data from all over the place. And that is why even an end-to-end design, an end-to-end organization model does not really do the trick in extracting the full power out of advanced analytics. And what we try to do with our ATOM, algorithmic target operating model approach, is that we are not only implementing what you see here on the left-hand side, isolated pilots, a predictive sales forecast in sales, and a revenue forecast in finance, and some operational forecast, or an AI pricing, or whatever the pilot is that you are working on. We are not trying to stay within a certain silo. We try to have the different, the models, the algorithms, we try to have them communicate to each other. So we are interlinking them, and that's what you see on the right-hand side. And if you not only have a sales forecast but you start linking the sales forecast to your production planning, then suddenly you get a leap in productivity, in process efficiency, and you have, again, a neutral discussion point, not only for sales, but also for production. And the more you do that, the more benefits you get. And in general, we say it's a factor of 10. And if you do that, and that is what the leading companies do, is they have to first take a very conscious decision who is driving that. And what you can do is you can drive that out of finance and only for finance. So you have models which only address finance elements. And in my later example, I will stick to that because we are a finance community. So I'm sure that you are all very familiar with what we have here. So that is finance only. In the mid, what you see is you have things that are driven by finance, but they can include sales, production, marketing, whatever the function is. What you could also do, and that is the highest level of business partnering and the highest level of maturity, and that is you as the business area, you drive the whole analytics topic throughout the organization. And you are not the one and only driver. You coordinate, your business partner, you bring together. And that is the highest maturity, but that leads a lot of prerequisites. So you need to be positioned properly. Finance need to be accepted as a neutral partner in the area. So, but that is important to understand. And for each of these areas or categories, over time, what we see is there are kinds of, we call this the atom initiatives, meaning there are groups of isolated advanced analytics use cases, which in total form what we call an atom initiative. For instance, if you think of profit and loss reporting, smart P&L reporting, you can have a lot of advanced analytics use cases contributing to that. Process automation, tax optimization, or driven by finance. Cash flow optimization includes a lot of other departments, P&L steering, risk evaluation. Or if you say, okay, as a business partner, you could engage into a sales up initiative. And there you would include a lot of different modern technologies, modern approaches from different areas, and you would coordinate that. And to give you a little bit more idea what I mean, because it could be that this sounds very abstract to you, I will, once the laptop allows, first show you, this is an example from a client which engaged already in a lot of these initiatives, like process automation, as I said, efficient P&L steering, and so forth. And this is the concrete example. So what do you see here? And don't worry, it looks very complex, but it is not. What you see here, this is from within the finance function or finance area. It is a list of all the advanced analytics use cases or pilots they already have in place. So in reporting and accounting, they already engaged. The design is a little bit off on my screen, but what you should see here is a lot, like what Ralph will talk later on, they implemented a lot of bot support and smart automation in order to facilitate the reporting process. They already have some first experience with process mining. In the financing area, they have a pilot for cash flow prediction. I go a little bit down more in the pure functional. They have some pilots for group consolidation, for material costing, for product costing. In sales, like this AI pricing, where an AI solution helps them to get a better understanding of what the pricing position should be, and so forth and so forth. So you see, they are already very advanced. And now they said, okay, how can I do a modern P&L steering and use predictive for that? And I mean, of course, it all starts with a short-term demand forecast. But, and that is one important thing in this whole atom idea, there are input modules or input pilots. They are the core modules. And then there are elements, pilots, models, algorithms who benefit from all that. And in order to support the short-term forecast properly, we introduced, or not introduced, but we connected, we put together the market intelligence module where they did some semantic analysis. So they were crawling through the internet, through the newspapers, through the pattern databases to understand a little bit what's going on, which technology are probably developed in which fashion. This is from an automotive producer. And for them, for instance, it was very interesting to see how different engine concepts, like the e-mobility versus the classical engine and so forth, how that developed. So that was one of the input modules. But also, as I said, the pricing. So also AI supported there. And they had a need demand model. And they had a simulation model where the different segments contributed. And all of that was running so far in isolation. Everything and all of that contributed to a small extent. But now that it all contributed as input elements or input data for the short-term demand forecast, they could, based on that, do that one properly, and then feed the production and the cost forecast, do simulation there, and also the manufacturing cost forecast, and do simulations there. So this short-term demand forecast was the input for these two models and algorithms. And with that, they could then feed the P&L prediction, do a simulation, and the whole analysis there. And next to the fact that now this P&L prediction was on the same level as far as accuracy was concerned, it was not way better. It was not way better. It was pretty much in the 1% to 2% range of being accurate. So a little bit better, but that was not the point. But the whole process there was so efficient and streamlined that they saved up a lot of discussions and bottom-up planning and consolidation and template exchange and everything that usually happens to come up with a proper plan. So it took out a lot of manual work, it speeded up the process, and the result was a very neutral, objective starting base for them to use. So that is important to understand. The benefit is not the accuracy. It is pretty much the same as if you invest hundreds of man hours into, or person hours into that exercise. But it speeds up the process, it's neutral, it's objective, and the modules can talk to each other. And if you've done that, you can of course use that also then for some additional analysis. And as I said, this is just one example highlighting how at that client, how the at-home idea was approached. And as I said before, or in the slide before, this was just one out of 8 at-home initiatives that they engaged in. And a very cool thing. And we are a little bit short of on time because, I mean, I could talk about these things for hours. I just want to also point your attention on one thing, and that's the underlying technical prerequisites for infrastructure. And I don't know if you have seen that. We at least have been discussing with our clients for many years how what we call the digital intelligence landscape should look like. And there are different elements to it or components. This is not an architecture picture. This is more, what are the different components that, again, here need to communicate and talk to each other. And you see here, in order to have a proper data presentation, of course, you can support that with algorithms and bots and so forth. In order to get the data, you probably need a strong ETL module. Maybe you feed that with a lot of spidering technologies, and all of that rests on some infrastructure. And there are additional components. And what you hopefully can see on the right-hand side is for each of these components, there are a lot of technologies that support that. And of course, here the monolithic strong systems which act with the promise of we have it all integrated. and they have been promising that for, I think, 30 years now. Of course, they are them as well. And you see it's already a pretty crowded overview. And in order to be able to really understand the pros and cons of each of these little technologies, I mean, you really need to be up to date and know the state of the technology and the state of art in that respective element. But this is the slide from 2018, which is 3 years. 3 years, and what you will see here, that's the picture from last year. And what you can see here is that there are today so many different, highly specialized tools that you really have to make conscious decisions about whether you want to put your focus on and which technologies do you need. Meaning, if you really want to engage into not only implementing isolated, predictive, advanced use cases, if you don't want to do that use case by use case and pilot by pilot, if you want to approach that with this atom, this more integrated approach, you first have to decide which initiative, what is the primary objective I want to achieve? Is it better P&L planning? Is it some of the other areas? And then pick the technologies that you use for that, because you will never have a full picture. And this is also the reason why we see in today's business world, business and IT are collaborating way more, because there's not one single party who can cover everything. And that is also important. So in this philosophy, it's a more collaborative approach between all the functions. And from our point of view, it's best driven out of finance. So how do I conclude? Well, there are 6 success factors that I would say that we identified over the course of the last years, what makes such an approach, this atom approach, successful. And the number one thing is think big. You have to understand that what you are doing there is not the implementation of a tool. It's not a leapfrog increase in technological capabilities. It's a complete transformation of how you run the business. And the better you are in this transformative mindset, the better it will work out in the end. Also, what we learned is, and that is number 2, identify a real problem that you have. Don't start with the low-hanging fruits, because that is a phase about 1 or 2 or maybe 3 years ago with your first pilot. There you got a feeling about what you wanted to do. I think today you all know the pros and cons of algorithms, of robotics, and so forth, at least to an extent that you get a fair enough feeling. So if you approach the atom, what you should do is take something where you really have an issue and then check what technology can do for you. And that is number 3. And for that problem, use the full spectrum of technology, from robotics to machine learning. If you don't have it in-house, work with a partner. You have all the options today. Focus on added value. And that is very important. Since it's a transformation, and since we are not shooting on the low-hanging fruits, shoot for something that you really, or where your organization really understands, okay, this is adding value to us. And then you need to embed it. As I said, we think it's best set within finance. And what you also need to do is, from our point of view, you need to apply all of that in a very agile approach. So no 2-year planning, and once you start implementing, the plan is already outdated. Smaller steps, fail fast, understand what you can do better, and do it initiative by initiative. And by doing that, I mean, in 10 out of 10 cases, it works. So I would say it's a good bet, and I would say it's worthwhile investing. So that was what I wanted to share with you guys. Thank you very much. Jerome, I think back to you.
Thank you. Perfect. No, to me. Thank you, Mario. Thank you very much. Very insightful. And you stay, of course, with us to answer the question for the panel afterwards, after the three speeches. Thanks again, Mario. Let me now introduce to Kleber Sasaki, who is a controller manager at Clariant North America. For the one who are not aware who Clariant is one of the largest chemical company in Switzerland. So Kleber is with Clariant for now over 14 years. He has been working there, managed a lot of projects and function there. He holds a bachelor's degree from the University of São Paulo in Brazil. He has been working there at Clariant as a regional controller responsible for Latin America, Europe, and Middle East and Africa. And he also worked as corporate controller at the company headquarters in Basel. During his time in Basel, in Switzerland, he joined several initiatives related to digital implementation for finance. Kleber, the floor is yours.
Thank you. Thanks for the nice introduction. First of all, I would like to say thanks to Dr. Mario Stefan from Horváth Partners for inviting me to share a little bit of my experience back in 2018 when we started with the journey of our digital implementation. And also thanks to ACCA and IMA to make this event available. Let me jump here to the slides. So as mentioned before, I really like to share back in 2018 what was my beginning of the journey of the digital implementation for Clariant. Also want to share some of the findings during the process to move towards to digital. That's why I would like to share a little bit the table of content. So really to explain why digital for finance was important, and it is important still today. How we actually work ourselves to understand what our current capabilities, and also how to really find the best solution that fits better to your company in terms of assessing third-party companies, partners, and also try to evaluate what's your current capabilities inside of your own company. And last but not least, unfortunately, I can only share 2 slides, but I want to show what was implemented at the very end. So, most important question, why should we move to digital for finance? I'm a big fan of this slide here. On the left side, you can really see the reporting and data collection in the pyramid that really takes most of the time of finance organization. That leads to less time for analysis and insights, and pretty much not many time to invest with advanced analytics. On the left side, that's what we consider to be a more operational finance, that really most of the effort and the resource are allocated to operational activities, which leads not too much time to support business. On the right side, that's what you can actually achieve with a digital project when you link your current process with robotics, with machine learning, with algorithm, whatever you want to name it. So basically, you can improve the utilization of your company resource. So take the example of the reporting and data collection. By the usage of robotics, you can really make your process more efficient, more lean, and you can really make the same resource available to invest more of his time in more analysis and to find more insights of the business. And also gives a more space also for advanced analytics. So on the great area, that's what I like to emphasize, that you move towards to more strategical finance. You generate more efficiency, and then you can better relocate your resource that you have in your company. In the end of the day, with a higher throughput of analysis and insights, and by the use of advanced analytics, there you can really boost your finance department to make a huge impact into the company and also giving insights to the business. That's pretty much what we normally like to say is from business intelligence to intelligent business. So what does intelligent business mean? Well, pretty much we use the algorithms and machine learning to try to identify correlations between, so in our company, in this case, Clariant, and with and we make the correlation with external factors. Of course, you can always use the information which is available, but how can you really access different sources, try to combine them, and to make the best usage? Yeah? So with a digital solution, you can always include some variables on your calculation for analysis, like industries going up and down. Take examples like automotive industry. What happens to your business when you have a plant shut down or when oil price goes up? So you can really include that as part of your analysis. Other factors would be weather conditions. Well, take one really example that we had recently. We had a winter storm in the US. So how does this can actually impact my business? How this can actually influence my supply chain? And last but not least, you can also include some macroeconomic indicators that can also support your analysis, meaning GDP, inflation, or even FX rate. That can be all combined to support your business, to support managers or senior managers to take the best decision. Now I would like to talk a little bit about the internal assessment. So we need to evaluate what's your current capabilities in terms of company. Do you have the right resource? Where are you standing in terms of this journey? So in Clariant, before we really start to move towards to many digital solutions, we actually looked internally. Where are we good? Where we need to improve? And what is missing? So in our case, we understood that we had already like a ERP integrated system, which definitely facilitates when you talk about digital solution and also implementation. We had two strong areas, which is our GBS, some of the companies shared service center, and we also have a really strong finance department. So GBS being responsible for all the end-to-end process, order to cash, source to pay, data to insight. And they're responsible to do the mapping of the end-to-end process. And they were, back at the time, they were already using some robotic solution to make the operational part of our activities more efficient. We also understood that we had so many reports that we could actually extract the data, but there were many Excel-based, many files, a lot of links. There was some room for improvement, and especially when we noticed that there was also some mistakes that we could prevent by the use of digital. Yeah? Also, in terms of the timing of the report, they were mainly provided after the monthly close, which might be sometimes too late to take some decisions. So we basically understood that we had an integrated system, we did have our capabilities internally, and we also understood that we need to improve in some areas. What we didn't have at the time is really a tool base with modernized real-time information that could use algorithm to give some insights and also some speed reactions to the market. What we also understood is that by not having such tools, the business units, they start to find their own solution internally, which gives us the opportunity later on to understand what we can change, make it better, standardize, and also make it linear. To understand better what we needed to do in the very beginning of our path, it was done a global workshop with our finance colleagues, and also we had GBS invited and also other departments, so we can all also share our view in terms of what we need to do and what our first project in terms of digital and algorithm should look like, and what they also should be covering. So there were 4 key items that really support us to define in which areas we need to focus on it. So first of all, we need to be worried about our data. So the tool has to have a really key elements for data protection, user access rights. Other point was the connectivity. So we need to, can we access from other platforms? Can we evaluate? We have access to the information using our mobile phone or our laptop. So can I access the information from any location? Third point, and also important, is really the cost base. We always need to be on budget, and we need to make sure that we select the best partner to start this journey with us. And last but not least, really important, what was really the point that we need to focus and we need to improve to really collect the benefit from digital implementation. Back in 2018, we really identified that for our net working capital reporting, data analysis, digital will definitely be useful because of the granularity level of information that is required. So backward information, customer product combination, payment terms, and that combined with macroeconomics would support us to better improve our net working capital. Again, with the scope definition and also with the areas that we really want to start, it gives us an indication. This slide shows Clariant today, but today means 2018, where we're standing now. So currently we have reports that are provided by the end of the month, which only help us to describe what happened. So the month is already gone and did not help us to prevent what will happen next and what actions can we take in order to prevent or to be more proactive. So the Clariant tomorrow is where we see ourselves nowadays, where with the usage of such tools, we can better try to anticipate our moves. If I move to the next slide, also important part of any digital roadmap implementation, testing solution in-house and also try to understand what is available in the market. So to run our pilot for the net working capital, we invited several companies to partner with us to analyze our data. In the end, with some filtering process, we came to two options that also accept the challenge to first receive our data as is, meaning we extracted information since back in 2014 up to 2017. We provided 2 countries with several customers and business units, and we asked the 2 companies and also our internal GBS organization, can you please, with the provided data, project what will be the customer and business behavior for the next 3, 6, and 12 months? Can you show some insights where we can actually improve our net working capital, meaning account payables, receivables, or inventories? Can you also predict some insights and show in a really online solution base how this can really pop up some alerts in case some areas needs to be improved? So basically we had 2 companies outside of Clariant and our internal team of GBS and DTI. They all received the same data, and we asked them as a pilot, well, if you tell me that your algorithm is so good and can run this predicted analysis, can you please show us? We managed to kick off the pilot. We got some outcomes, general, from the 2 companies, and also what was done internally was actually quite accurate, which also shows the strong capabilities and also the solutions that we have available in the market. I don't want to go too much in the details in this part here, but basically what we could find out here is that from company A is just one example. For the account receivables, they really had a really impressive, accurate forecast. Keep in mind that we provided information from 2014 to 2017, and we were already in 2018, so we had the actuals, so we could really compare and really evaluate if the forecast was accurate, and it was actually quite accurate. We also learned that some of the companies, they do have their internal, they call steering lab, which shows a strong capability of the partner to really solve your issues and take your questions in-house, which was not the case for company B. They did provide a good, accurate forecast, but more limited to some key customers, while the other company could really provide in a range of country, top-down analysis, more detail, product base in a really more transparent way. And also really happy with the outcome of our own internal GBS organization. As mentioned before, we had already everything that we needed internally to really kick off this project, but we really need to understand what was the capabilities outside and what we needed to improve internally. And of course, with our own internal team, also with GBS and DTI, they managed to also run a nice, accurate report. They managed to also identify some root cause for the impact in our net working capital. Also propose some improvement. Most important, they actually had some advantage because they knew our internal process. They also came up with a process improvement to avoid several spreadsheets, a lot of consolidation, and they really managed to make that in a nice way that we can better understand and prevent business discrepancies, especially in the net working capital area. So I just want to share, at the end of the day, what we develop and what we are currently also using here at Clariant. We do have this dashboard view with accounts payable forecast. So here on the left side, you can see the actual results for one selected business unit from also one specific region. And the algorithm that we are currently using support us to project what will be the behavior in terms of accounts payable for the next 12 months, but also give us a short and more detailed view of what we can actually assess in the next 8 weeks. It does plays a big difference when it comes to liquidity analysis. And maybe we can take nowadays problem with COVID. It does impact all the business, and luckily we started this journey, and nowadays we are better prepared. And even knowing that it's still unclear what will be the side effect of COVID, we can still use a lot of our digital tools to support us to better connect with other departments, make sure that the business is aware about what will be the implication, and support them to better plan how to take discussions with customers. Also, the second page here is our accounts receivable forecast. Unfortunately, I cannot display here the figures, but just to share some views here. On the left side, that would be our customer, and the size of the squares represents the revenues in terms of development from the last 12 months. On the right side is the materials related to the customer. So we know which customer represent X percentage of the purchase of the materials. Below, you can also see the days in all the invoice. So that's also important to have really the granularity level where you can really pop up the details which is required. Do we have any invoice that will be paid late? Do we have any customer that historically and linked to some algorithms and outside factors tends to delay? So we need to always inform the business so they understand how they should better react that and respond, and really avoid the overdues and the customers not paying time or not setting the right price, knowing that some of the customer might delay always 3 to 5 days in terms of the payment process. And since this is a pretty much online tool, all of our finance department as well, some regional heads of the business, they have online information. They don't need to depend on someone to download, extract information, clean up the information, and put some projections. So that's really a lean process that was only possible to achieve with the digital implementation. And last but not least, I really like this slide here as well. As part of my conclusion, when it comes to journey of the digital implementation, normally what the colleagues tend to see is always the final transformation, how you can move from the operational to strategical. They also can see the new functionalities of the tool, and they can now really improve their finance organization to move from operational to more strategical, to really boost the value adding thoughts from finance to leverage business. What normally people tend to forget is that it's really important when you start your path with digital make a really nice assessment, go for the analysis, try to dig into what kind of reports do you have, what is the constraint in all the process. Try to evaluate what is the redundancy that you have in countries to avoid that you really create something that should be used also in the countries, to avoid that company invests a lot of money in digital solutions. Suddenly when you are aware of someone is really running a local Excel spreadsheet and should be already using the integrated tool. Important is also to make sure that the training is always available when such tool is rolled out. Assessment of the best options in the market. Of course, this was one of our initiatives. We had several initiatives right after with partners, not only our internal team. So it's also important to understand what are the capabilities in the market. And I must admit, every time when I join an event, I can really see how this is developing quite fast. Also, it's important to make sure that you have the right budget allocation and you can really focus on the items that will generate the most impact and benefit for your company. Important is also, as Mario also mentioned, is really the cross-function interconnective with other departments. In our case, it was finance with the support of GBS and also IT. So really putting the three departments to work together to develop this the digital roadmap. And last but not least is really the mindset change, how to really move away from our old package to convince the colleagues that the new tool, it's quite functional and they can rely on, and that they should really focus their time in more strategical thinking instead of operational process. With that said, I conclude here my presentation. Thanks a lot.
Thank you very much, Kleber. Thanks a lot. Very practical experience from client from you. I hope you inspired a lot of our members here. Thanks a lot for that. Let me now welcome Ralph Landolt, who is a co-leader of AI and automation practice at Boydac. Ralph is an expert in AI used for automation. After his technical studies at the Zurich University, of course, in Switzerland, and several years working in consulting for BCG and Bain & Company, he's now leading, as I said, the practice of Boydac in the AI and automation area. He's also holding an MBA from the INSEAD Fontainebleau and Singapore. Ralph, the floor is yours.
Thank you very much, Jérôme, for the very kind introduction, and thanks everyone for having me here. So I'd like to share a couple of thoughts about this topic of prediction and automation. And prediction is a very difficult thing, actually. If you think about it, if you just imagine you're a farmer 200 years ago, and you get the task to figure out how does the future of work look like. So you would have to predict how the future looks like. Probably you won't come to this picture, or also you won't come to a video like you see in a bit of a modern production facility, like you see here in Espresso's world. So making predictions is actually something very, very difficult, and it's very tough. But we have seen in the examples that Mario has shown us, and also the very impressive example that Kleber has shown us, it's actually possible to predict at least some parts of the future. Maybe not the very long-term implications, what will happen in future, but maybe a bit the shorter, near-term things. And I'd like to talk a little bit about our experience here, and hope this is also going to be a little bit inspirational for you. Before we kick off, I'd like to ask you one question. And this question is, have you already written your own enterprise used machine learning prediction tools? And I was thinking we'll have the poll in a minute up here, right? So are you already using machine learning prediction tools? So yes, that's business as usual for us, would be option 1. 2, well, somewhat, we're running some first pilots. 3, no, we're just evaluating options. So I'll give you a bit of time to consider which option you would like to click. And then once you have submitted, let's see what then comes out. So another 5-6 seconds. can look through it. And now I'm really excited to see what comes out. And I'll hit the next button. All right. So we see the majority, 2/3, said no, we're still evaluating options. And about 1/4 of people have run pilot. And we see how what Mario and Kleber just shown, they're at the forefront with a bit less than 8%, a bit less than 10% they are into using algorithms already day to day. So I'd like to explore this a little bit, what this means using algorithms, and also what Mario alluded to, how it could maybe even change a business model. So if you look at it, you might know this here, right? You're shopping on Amazon and you get personal recommendations. So this is nothing other than a prediction, what would you buy next? And of course, Amazon has invested a lot of time and energy into making this algorithm very, very good. But at least for me, it only works in about 5% of the time. So it's not that accurate yet. And still, Amazon tries to invest more and more. I mean, why is the case it's not accurate yet? One reason is for sure that Amazon doesn't yet have all the information. So for example, they don't know the balance on my bank account, for example. Or they might not know so much about my relationships, friends, and so on. So there's still information and data missing, but who knows, maybe Amazon will gather more and more over time. I mean, you know, they also have their Alexa devices that we use in our homes. They listen to us sometimes. Let's see how good the algorithm comes over time. And maybe one quick thing also to keep in mind for the ones of you who use Google, you can go to myAccount.google.com/purchases, and if you use the Gmail account to actually get your purchase receipts and so on, you can figure out on there all the purchases you have done over the last 10, 15 years, as long as you have used Gmail. It's very interesting how Google also learns just from the mails we receive what type of things we buy. But let's just now do a quick experiment. Let's think about what would happen if Amazon's prediction algorithm would get better and better. Like the volume dial you have on a radio, you put the volume louder and louder, and I'll show you a quick movie to think about what it would mean if you put the Amazon prediction algorithm to a volume of more than 10, the maximum even to 11. So let's run that.
Top to what we use on stage, but it's very, very special because if you can see, the numbers all go to 11. Look, right across the board. 11, 11,
and most of
11,
the amps go up to 10.
Exactly.
Does that mean it's louder? Is it any louder?
Well, it's one louder, isn't it? It's not 10. You see, most blokes are going to be playing at 10. You're on 10 here, all the way up, all the way up, all the way up. You're on 10 on your guitar. Where can you go from there? Where?
I don't know.
Nowhere, exactly. What we do is if we need that extra push over the cliff, you know what we do?
Put it up to 11.
11, exactly. One louder.
Why don't you just make 10 louder and make 10 be the top number and make that a little louder?
These go to 11.
Ladies, all right, it's time to turn it up to 11.
So, that's of course out of a movie and a little bit of funny, but if you think about it, if the accuracy of the Amazon forecast model would go to 11, as we have seen here, what would it mean? And if you look at Amazon business model at the moment, it's you shop online and then they ship. But actually, if the accuracy of the recommended next purchase you'll do will be 100%, it would switch their business model. They would ship first to you, and then you shop, because you know, for example, your coffee machine is broken, and then you open your door, and there's a package from Amazon with a new coffee machine, because their accuracy of prediction is already so well. So their business model will fundamentally change with very accurate prediction. It actually doesn't even need to be 100% correct. You could imagine to switch them already to the shop, from the shop and ship and shop model by 80% accuracy, because you know you might send back a couple of things, and it would enable Amazon to actually enlarge their share of wallet very quickly. So prediction is something that's of course very hard, but also something that can trigger a lot of actions and changes in business models over time. And Gartner has predicted that that's the top technology trends, a couple of things for 2021. I'd like to pick out three ones on the right-hand side. And specifically a lower one, the hyper-automation one. And this topic, hyper-automation, together with prediction, is a bit a strange one. So I'd like to show this with a small picture. All the parts that you might use, and Mario showed this very nice zoo. If you look at this slide, all the different technologies that are available in such a disjointed manner, they don't help you so much. What you actually need to do is you need to bring them together into one integrated solution that helps you to predict better, but also to automate your business processes better. And what we really think is interesting, and where business transformation then also is driven by the prediction, is when you combine the prediction, like in the Amazon example, then with action, with the actual delivery, and you do things. You don't only predict, but also do automated action. And this is where I'd like to do the second poll, and to understand, are you, for those who actually use prediction tools, already combining them with automation? The first answer is yes, of course, that's business as usual for us. We do combine prediction with actual automation and the action. Or is it two, somewhat, we are just running first pilots, or actually, no, we're now combining our prediction with automation. That's something very new for us. So let's see how this looks like. Give you a couple of more seconds to consider your answers. So then let's jump how it looks like. Always the exciting moment, what it will be. Remember, it was about 8% actually that use prediction algorithms already. So, it's very interesting. So for the 8%, almost 6% combine them with automation. Very impressive. And then again, about 2/3 still evaluating options. This is very interesting to know. So the companies that actually already using prediction combine it to in a lot of cases already with automation. And, I'd like to share now 2-3 thoughts about all the prediction tools that are out there. Marco showed this very nice zoo, and also Clever showed a bit, how they evaluated various partners and players. I'd like to present you how to think a bit about various categories of tools. So there is one prediction tool set that's just like standard Lego bricks. You just use them, plug and play, and you can do whatever you want with it. So not much, let's say, algorithmic know-how to use or to actually have in-house, but of course you can't adopt it so much to your own needs. It's the standard Lego bricks. The second category is what we call the Lego Mindstorm ones. So this means you have to configure them a little bit, you have to parameterize the models, but still it's a predefined set that you can actually very easily use. And the last category, and use here the Big Bang blocks from the Caltech, from the ones who know them, actually you develop your own model with your own data, which is of course a very different kind of tools that you use. And it seems like also this is what Clever and the Clarion guys have done in a very interesting and impressive way with a couple of partners. So the first ones are very standard tools. For example, you can use face detection, where you can predict the emotion of a person and the face. This is available. You can have language transformation, where you can predict what's the language. You can do speech-to-text conversion. These are all standard Lego bricks you can use, easy off the shelf. You can also use, and for example later on, the Mindstorm bricks. And Amazon, for example, they provide their own forecasting engine and also the recommendation engine to third parties. You can actually use it as a service, and you pay per call you make to this service. But you have to configure it, of course, with your parameters and so on. Also, Microsoft offers stuff like this, Google, and is in the background the whole technology, as you heard from Mario. And last but not least, of course, you can go to the nerd platforms, as I like to call them. You can use Google TensorFlow, Facebook PyTorch, whatever it is, to also the nice tools that Mario presented from their steering lab they have. So actually really, you need a really lot of compute power, really lot of experts, and then you can develop your own models in very interesting, generate very interesting results. What I'd like to show you now, before we close this session here on my side and enter into the discussion, is one quick example, how you can combine automation and prediction. And in this case, it's a use case where you do some data preparation. You like to predict in various branches you have what is going to be the revenue over the next 2-week period. So what you have to do is you have to, of course, collect all the relevant data and prepare the data from your ERP systems. Maybe it's weather data as well, because it's important, your past history, and so on. Then you have, of course, to clean the data. In this case, you can do this with a bot, you can do this with various algorithms. And then you go to the actual prediction. And this is where you use, for example, the Amazon forecast tool, where you can predict using their algorithm, inputting your parameters. This is my past history, so you can train it with your past history, and then you can learn, let it learn and see how well the prediction is. And let's say, for example, you predict the sales for a branch to go down. Now I can trigger action, and I'm talking going down over the next 2 weeks, so very short-term prediction. So then you can, of course, use again automations to trigger, for example, the branch lead and say, hey, the prediction for the next 2 weeks is actually for your sales going down. Please take action and inform us what the actions are. And what actually comes out are sometimes very, very simple things. So, for example, if too many people in a branch are on vacation, the prediction for sales going down is very high. So it's very simple stuff that actually in the end comes out, not so much magic, but the whole controlling and predictive controlling works in a very automated way. What I'd like to conclude with is there's so many tools out there. And of course, the question is which tool does the right trick. And of course, you don't should start from the tool, but actually, as Mario has very nicely explained, start from the big business logic, which problem you actually want to solve, go very strategic about it, and then only in the second and third order, think about the right tool to solve your problem. In case you're interested in so much more reading about prediction model, I can highly recommend this book, Prediction Machines. You can also scan this QR code. You'll receive anyway the presentation afterwards. If you're interested in that, there's a couple of more examples in there. I think it's a very interesting book if you want to dig a bit deeper into algorithms and specifically what it means for business. So it's a business book, a technical book. I'll highly recommend it. That was it from my side.
Perfect. Thank you very much.
Thank you.
Marco, can you
Yes.
please take over the moderation of the Q&A? Thank you.
Yes, thank you very much, Ralph. I think you took it really a step further to combine predictive analytics with intelligent automation. Yes, we would like now to move to the discussion and Q&A. We already received a lot of questions from the audience, so please keep asking them. We would like to address as many as we can. So, yeah, overall, I must say, I think the speakers have clearly shown that the business opportunities in the field of predictive analytics are huge. Not surprisingly, the global predictive analytics market is estimated to account for around $22 billion by 2025. This is compared to just $7 billion back in 2019. So this really highlights the expected growth in the coming years. So maybe to get started, I would like to ask one question to all of the speakers. And it's really related to the current events, COVID-19, of course. I would like to know from your perspective how COVID-19 has changed predictive analytics in the last year, compared maybe to the evolution in the last 5 years. And yeah, if you'd also like to predict, what do you think will happen next in this field? So maybe get started with Mario. and then take it from there.
As I said before, the whole COVID crisis identified one thing, and that is that all the companies who invested in topics like that were way better off, because they, in most cases, they had to look at their processes and ask themselves, what is the most critical process for me? So they knew exactly where to mitigate in the initial phase of the COVID crisis. Those who have predictive models were way easier than do the simulations, because most of them had some underlying driver models. I mean, that's what you in many cases do. You develop a driver model, you start predicting the drivers, and by doing that, you get the final prediction. So the ones who already had the driver models were way faster in doing some simulation, how the whole crisis will turn out, and develop different strategies. So I can say, just as I mentioned, addressing the topic and dealing with it and asking yourself, where are the benefits for me, where not, all the companies who did that had strong advantages during the crisis. And of course, today, the ramp up was faster, the recovery was faster. And now this whole market cleansing, which is taking place, once that's through, they will be way better off.
Very good.
Amen.
Maybe as a follow-up, there was a question from the audience on that. How do you arrive at the factor of 10 for the benefits? I think it was mentioned on one of your slides.
Yeah. We can see that by comparing the same amount of investment. Let's say you invest 30 external consultant days. That's our currency. So you invest 30 days. And what do you get out of it in the end? If you focus on an isolated pilot versus you invest the days in coming up with one initiative and then not focusing on detailing the one single thing out, but more how this whole thing works and then implement. Kleber said it perfectly. I mean, he looked into the market, he understood what the different providers can do. And once he understood what the possibilities are, he did it in-house. And by comparing these approaches, we end up by a return investment, which is typically by a factor of around about 10. I mean, sometimes more, sometimes less. That's strategy number one. And strategy number two to calculate this increase in return is by, and that is the entry calculation, you're just adding up the different pilots. So one pilot compared to 10 communicate to each other. In both scenarios, you end up seeing that the impact is dramatically higher by following this whole atom philosophy.
Okay, thank you very much, Mario. Maybe Kleber, from your side, how has COVID maybe impacted not only your business, but the whole redesign you were doing in the finance function?
Definitely. I mean,
analytics.
COVID-19 impact was pretty much unpredictable for most of us, especially at the very beginning. But definitely, as Mario mentioned, we had already established our tools that provides online data and can fast react. So imagine if that would not be implemented and we had to wait 1 month to have the closing to later on start to take the decisions, how to approach suppliers, how to approach customers. So in that regard, of course, to have COVID impact in the algorithm is pretty complicated. I'm not sure if that's even something that you can rely on because it changes from time to time. But definitely having already an online solution that brings the data online and also creates the awareness about the application case we don't have the fast response, that would definitely cause a lot of issues.
Okay, thank you. There's also a good follow-up here. Question from the audience: what sort of assumptions are made to predict the future on the back of major upsets like COVID or the financial crisis in 2018? What kind of assumptions? Do you have some special assumptions there in your algorithms at Clariant?
No, for COVID, it's pretty much what we get from outside information, right? You can see also the development in GDP and then we know where we have our strengths in some of the regions where are most impacted or less impacted by COVID. Then we can have a better assessment what's the impact, and we can fine tune too. Okay, clear. Good. Ralph, maybe your perspective on the COVID impact, and maybe also on the whole industry, predictive analytics.
Yeah, so what we see is the companies that have invested into data, transparency, analytic capability can then react a lot faster. You will not be most probably able to already account for all the situation that might come. Classical black swan thing, you don't know what you don't know. But if you have the capability to actually analyze your data very quickly, get them together very quickly, you can, of course, run various things. And when you get new situations, you're very quick to deal with that. If you're not able to even get your data very quickly together and analyze them, it's also way more difficult to do predictions.
Okay, very good. So before we go to more questions, I think we have another polling question we can ask. So Levki, please.
Here it is, Marco.
Perfect. So yeah, we would like to know in which financial departments you see a digital solution with the highest potential.
So if all the attendees can please complete this, if you can all select one of the 4 options we're giving here. And here are the findings, Marco.
Perfect, thank you. So very interesting, accounting and controlling. Maybe any reactions from the speakers on this outcome?
Well, I think from my side, reading here the data, 50% for controlling, I think it really shows that maybe most of the initiatives that we have available in the market, you can really see on the ending customer, like when you talk about price improvement, relocation of resource, that's much more like a controlling initiative, and maybe there you can find other options. And for when it comes to accounting, will be apologize. And then for accounting is much more like end-to-end internal process that we can also be supported, but maybe you don't see already immediately the impact from a business point of view.
What I wanted to add is, you see from our experience, you typically start in accounting because you have highly standardized repetitive processes. So it's way easier to start there with a process automation, some robotics, and also the entry in predictive is accounts receivables, accounts payables. And then over time, and that is, again, the whole idea, once you combine the different models, there is no distinction in accounting, tax, treasury, controlling anymore, because you start interlinking them and you use different areas where you need them to make an overall prediction on something. Hence, I would say that this picture is a mixture between where do you start, that's accounting, where's the future potential from an isolated use case perspective, it's probably in controlling, that's the biggest field. But overall, the thing is not to think in these different categories, but to think in what do I try to achieve, where do I get the value, and then take the different pieces out of all the areas.
Very good. Maybe Ralph, from your experience?
So what I can actually just add to this is that the finance function usually, in terms of when you look at what you can do with prediction and automation, is in compared to the overall company, usually a small part. Just in terms of number of staff, not in terms of impact I'm talking now. And what we see, of course, not only in the finance function, a lot of impact of prediction, but also knowing things like supply chain. We see also a lot of prediction that's actually helpful for manufacturing parts and so on. So there's a lot more than only in the finance function. This is the part that I can add as well. Of course, this is a finance community, so I fully understand this focus here.
Yes, very good. Thank you. So maybe to follow up a little bit on Mario, I mean, yeah, what all three of you mentioned a bit, that it really helps accounting and finance professionals to become better business partners by adapting predictive analytics. And yeah, Mario, how you mentioned it a little bit in your presentation, but how would you say the Atom initiatives enable that transformation as a professional to become a business partner? And then also on the other hand, yeah, what level of digital maturity does a company really need to get started?
Yeah. You see, it all starts with small baby steps. It started probably years ago with some minor pilots, and now you're increasing the complexity of what you do. So I would say the level of digital maturity, yes, you need to have a certain level of standardized data, harmonized data. And that is a general recommendation. So if you ask me where to start, I would say start with cleaning up your data and getting the data layer right. And because they all the models, all the algorithms rely on data. Yes, and from there, as I said, start with the bigger picture. Ask yourself, what is it really that would add the most value to me? And then ask yourself, what are technologies that could support me in achieving that? Ralph mentioned a couple of things. First, you have to clean up your data. This is something you could automate with robotics. Then you might have some driver models where you say, well, I start predicting my key drivers with the biggest impact on my final result. And then you do that. And if you have the picture in mind, step by step, you extend the scope and you extend the functionality of your initiative, more drivers, more modules, and so forth. So I would say start small, have the vision in mind, and then step by step work your way to what you have to start, and start with it. When it comes to business partnering, I'm not sure if I understand the question correctly, but what I can say is, if you are a business partner, then you are not trying to push through your own agenda. Again, start with what is adding the most value to your organization. And if you are in this upper right category, what you do is you ask yourself, whom do I need? I mean, function-wise, what are the technologies that I need? And then you start working with all the people. And you try to optimize the outcome, the value contribution. And for me, that is something which makes you, but also promotes you as a good business partner within your organization out of finance.
Good, and maybe on the data side, that was also a question from the audience. How structured was the data input in the examples you showed? I mean, most of the struggles with AI is about unstructured data. That means cleaning, as you mentioned, before you run the data set. So how structured was the data input?
Is that a question to me or to Kleber?
To you.
Okay.
Kleber as
yes,
well, both, of course.
Yes, in our case, it's mostly structured data. This is one of the things we learned. We started with the assumption that integrating a lot of unstructured and external data, so more external than unstructured, but in that case, it's mostly unstructured, that would create a big benefit to the overall prediction and accuracy, which turned out that's not the case. Remember, it's for me, one thing it's so imperative to understand, and that is, the more data you have, the weaker your algorithms can be, and also the other way around. The less data you have, the stronger your models need to be. And in the corporate world, we don't have a lot of data, not compared to Google or Facebook. I mean, our sales data with all the product and so forth, that's in comparison not very much. So what you need to do is you need to have strong models, proven algorithms, and combine the models, robust models, which can generate the outcome. And in that scenario, in most cases, you rely on the structured data that you have, and you are not putting additional complexity with external data. In some cases, it's beneficial. In our experience, very often, in most cases, it's not. But Kleber, how was it in your case?
Well, in our case, again, I think what you mentioned is extremely important. So your data, looking back at your master data, what's the quality? You need to do some housekeeping before you really kick off a project. I think this is pretty much the foundation of any digital initiative. If you don't have a good quality of data, reliable information, it doesn't matter how good is your algorithm, it will never reflect the right forecast information. So I also, as a comment, I really emphasize housekeeping for the master data is extremely important.
And Kleber, how do you cope with the risk that implementation of digital finance, like let's say, takes too long? By the time you have finished it, it may be already out of date.
Yeah, just looking back to 2018 when we started, I would say that first, it really varies from company to company. In my case, we had the resource in place. We had a really integrated system. Also, the master data related to net working capital was somehow at the minimum level. You know, it's not that we wanted to have the full P&L and all the details. It was much more related to the customer patterns and business and regions. So that we could really select one specific section that we wanted to run the project. And with that and all the assessment of business partner internally and externally, we designed the scope, and then we really start to implement. But I think with a more agile approach, like running the information, checking the outcome, fixing. So it's really a journey. It evolves with time. Of course, now we are in 2021. I'm not involved in that area anymore, but I would say that from the very beginning to the end was at least 8 to 12 months. But before that, there was already a strong preparation to make sure that our data was already reliable, and also integration of the system.
If I might just add to this, so what really usually makes sense is if you do this think big, and start smart, and then also scale fast. You know, so start really big strategically, then deliver really fast solutions in a smart way to actually build momentum, and then scale it very, very fast. With this approach, you will not be late, as you mentioned a little bit, Marco, you know, to actually deliver on a digital finance transformation.
And maybe, Ralph, for you, there was also a question from the audience. Does then an agile approach run contrary to thinking big?
You mean, I think the combination is what I mentioned just before. Think big, this is the first thing. And then, you know, start smart, as I mentioned. Within the big landscape, you might, you know, choose 2 or 3 battles you actually go, and then scale really fast. Because what Mario rightly mentions, if you just start with the battles first, and you don't even know what the map is, you might choose the wrong battles. And you might also move yourself into a dead end. So just, as I mentioned, the algorithm and this tool choice only comes after your thinking big process. At least to my view.
Maybe two questions. Let me know who wants to answer them. I mean, which type of organizations will benefit the most from this technology? And on the other hand, what's the best predictive analytics tool for a project business-driven company?
Say again the first question, please.
What type of organization will benefit the most from this technology? Let's say for predictive analytics is probably.
Yes, a profit-driven organization. No, seriously, I mean, the more repetitive things are, of course, automation technologies help the most. So that's for sure. But in general, I don't see a lot of difference. I mean, automotive and financial industries, they are different by the underlying business logic, but they are both dealing with the same issue, and that is there are different factors influencing the final result, and you are not sure what will happen next. So I would say by a small extent is that not too product-heavy organizations like insurance companies, banks, and so forth, they might potentially benefit more from automation as such. And I think since the complexity of the drivers running into what's happening in a more product-oriented organization, they probably benefit a little bit more compared to the other technologies on the advanced analytics. But this is marginal. I do really not see, thinking about it, a big difference.
Good. Anyone else would like to add?
Ralph probably. I mean, he also has extreme overview over the market. Ralph, what do you see?
Yeah, so what we see is it depends not only on the industry, but also on, of course, on the function within an industry. So let's just take insurance, for example. They have to deal with a lot of, let's say, claims. And you can use prediction also in, actually, you try to predict from a claim that's just free text, where you deliver a claim. Is this covered or not, And you can now try to figure out, can I deploy machine learning models to predict whether this claim is covered or not, without having a human actually reading the text. It's very unstructured data. In this case, also insurance could use the prediction in a very different prediction analytics context that we've just discussed before when it's around forecasting. So I think it also depends a bit on the function within a company. But I fully agree. It's probably for every company and every function relevant to do a heat map analysis. Is it relevant for us? And for the project-driven business question, I think that's a very challenging one, because project-driven means, at least how I interpret it, very different every time, very customized, and every data set, is not relevant for the next project because the next project is very different. So there is going to be, I think, a bigger challenge to use predictive analytics on an overall basis than compared to an industrialized project.
Very good. So maybe as a last question to all of you, also to have a little bit an outlook. So do you see a risk of becoming irrelevant as a business if you don't use predictive analytics within the next years? Maybe start with Kleber.
Oh, that's actually a good question. Well, there's always a risk of being left behind, right? You always need to be ahead of your competitors. When it turns this into finance, does that mean to be moving from operational to strategical, and you're the first mover, definitely you have the leverage. So I do see a risk, with the quantity of the data that we have, the possibility to relocate resource also globally in the best locations and use the best benefit of all the digital solutions here with the risk if you're not willing to go through this path.
I mean, I can only agree. I mean, if you are not very well at predicting your core stuff and your competitors are, you will probably suffer.
From my point of view, I mean, that is a very deep question. Let me share just one or two points of view. First of all, the prediction is too narrow. It's about this whole modern technologies from advanced analytics to full smart process automation. it has a tremendous impact on the way that you steer your business. Think of shared service centers. I mean, a couple of years back, shared service centers were not only intended for labor arbitrage to get some cost benefits compared to organizations by bundling processes, put them into low wage countries and get a financial benefit out of that. But why would you do that if you can have a fully automated robotic solution from Ralph in your cellar? The cheapest accountant in some Asian low-cost country is still way more expensive than the most expensive robotic solution, at least in general, to make the point. So it changes the way organizations run their business. So they find a way with these new technologies to get things back into the headquarters. And if they have it back at the headquarters, they can do way more analytics because they have the data available. This, again, leads to not only process efficiencies, which improve their margin position and their cost position in the market, it also gives them a competitive advantage when it comes to differentiation based on customer intelligence and so forth. So I would say, if you are not engaging into making use of all these new technologies, from this AI on the one hand down to pure simple process automation, even if it's with an Excel macro, which is probably the entry point to all of that. If you're not using the full spectrum and what makes most sense to you, you will not get into a competitive situation then your worst competitor will have once he starts using it. So I would say there's no way around. And the question is just, what time do you have to start working with it? If you have fierce competition and you have new players in the market, then you do not have a lot of time because then you are outsmarted, outcost, and so forth. So yeah, I would say there's no way around.
So very good. Thank you for sharing your insights to all of you. So I think we can conclude the discussion here. Thank you, Mario, Kleber, and Ralph for your insights, and the audience also for your participation and questions. And yes, I mean, every business has to constantly make informed decisions based on facts and evidence in order to do things quicker, better, and cheaper. And if your question is how much revenue growth can we expect in each country or business line, then I think you will like predictive analytics. So before we close, I would like to say a few words about the IMA Switzerland chapter. So our chapter has around 300 plus members, which makes us the third largest IMA chapter in Europe. We are quite a diverse group of professional and student members and also very international. As a chapter, our mission is to help new members and students pass the CMA certification. Actually, our chapter also offers a coaching program. And then we also organize professional education events like today's and connect at networking events. So if you'd like to learn more about our activities, follow us on LinkedIn and also visit our chapter website. So with that, Jérôme, back to you.
Thank you, Marco. On ACCA, so we are, as most of you know, the largest and fastest growing global accountancy profession in the world with over 227 members. In Europe, we have 13,129 students and affiliates. In Switzerland, we have over 1,000 members and 900 students. So we are very proud about the growth and activity of our community in Western Europe. And Lefki is doing a very good job with Abdul to put that all of us together, in particular in this difficult time we have currently. For most of us, or I would say all of us, with this COVID and different and difficult situation we are facing. I hope all of you enjoyed this event, which was very provocative, very forward-looking as well. And I hope it will help all of you to be better in your job, in your career, now and for the coming years. Thanks a lot to all of you for participating, and I give the word back to Lefki for closing this event. Thank you very much.
Thank you, everyone. Thank you, Jerome, Marco, for putting this event together. This has been an excellent event, excellent speaker. So thank you, Mario. Thank you, Kleber. Thank you, Rolf. And we wish that you have enjoyed this. We do hope that you have enjoyed this event. Before you go, don't forget to download your certificate of attendance, with which you can claim 2 CPD units. So until the next time, stay safe and well. Bye-bye for now.
Thank you, Joel. Bye-bye.
Thank you.